Well, it was a strong holiday season marked by the strongest consumer spending in years. But all that shopping also translates into a lot of returns. And that means big demand for warehouse space, especially with the growth of e-commerce. Diana Olick explains.
As plentiful as the gifts were delivered to our doorsteps, close to $100 billion worth of them will be returned. And most will end up in warehouses like this one in Nashville.
What's going on behind me is the hangover from the buying season during the holidays when reverse logistics kicks in.
Reverse logistics is a fancy term for dealing with all those returns. While store shoppers return about 8% of what they buy, online shoppers send back close to 30%. And most of those items have to be brought to warehouses, checked for damage, repackaged, and either sent back to retailers, liquidators, or often just thrown away. Reverse logistics is now the #1 new user of warehouse space in the U.S., according to CBRE, taking up 700 million square feet nationally.
Demand for the space is only going to increase in warehouses unless and until we find a better solution to either return to the store or better incentives for consumers not to return the goods.
That demand boosts the bottom line of warehouse REITs like Prologis, East Group Properties, and Stag Industrial, as well as logistics companies like XPO Logistics, which both owns or leases warehouse space.
Warehouse REITs have been a hot sector since 2012 with the surge in e-commerce, and demand has generally outpaced supply despite a lot of new construction. There was concern that the trade war might hurt demand, but so far economic growth has offset those fears, and one of the strongest holiday retail season in years only confirmed that.
I don't think we're past the peak yet, though we had suggested earlier that we might have seen that. We didn't.
Because the more goods we have sent to us, the more we will inevitably send back. For Nightly Business Report, I'm Diana Olick in Washington.